Index funds are one of the best ways to invest in the stock market for both beginners and pros alike. They offer a cost-effective, diverse and passive way to get into the market and get your money working for you. This means that you can go back living your life, browsing Wall Street bets, looking for YOLO trades that didn't go down so well.
Counts with compounding interest and it's gone.
I have to admit it's a real self-esteem boost to that thread. Most professional traders and fund managers struggle to beat index funds that track the likes of the S&P 500 because actually it's incredibly hard to pick winning stocks consistently time after time over the years. And they've proven themselves time and time again because their fees are so low and they have the whole market tracked for you, so you're not going to miss out on any amazing winners. In this video, I'm going to run through some of the best index funds that you can invest in today that hopefully will grow faster than your waistline did during lockdown. Just a heads up, all the funds I speak about today are going to be ones that are managed by Vanguard, but of course they can be bought on multiple platforms or you can buy them directly from Vanguard themselves, completely up to you. One final thing to remember, I'm just some random guy on YouTube and I'm not a professional financial advisor, so take anything I say just from an educational standpoint and just my opinion. But without any further ado, let's get straight into the video. First, let's just cover off what index funds are and have a little history lesson about how they were created and where they began. Created by the legendary investor and founder of Vanguard, John Bogle, index funds make up about 20 to 30% of the entire investments in the equities market. Since the inception in 1975, money has poured in from everywhere, from retail investors like you or me, all who wanted a piece of the action and make sure that more of our money came back to our pockets rather than going to those fat cat traders taking those high fees for managing those funds. It's funny, when they were first created, they were actually looked down upon by all those snobby investors who thought, people don't want average market returns, they want our world-beating returns that we pay handsomely for. Well, how are we going to justify our own fees? Well, how wrong they could be, because it turns out in the long run, those average returns were pretty damn good once you took off those expensive fees and made sure that you had all of the winners every year. Once you've got the whole basket of stocks, you couldn't lose. An index fund is a really simple concept to explain because it's just an index of funds, a selection, a collection of stocks and shares from a certain index, and that index might be a country, a region, or something like the S&P 500 or the FTSE 100, for example. It's just a shopping basket full of loads of different companies pre-made, ready for you to take away and check out at the supermarket. Simples. The benefit to us investors means that our money is spread across multiple companies. We don't have to go looking for hundreds of stocks to pick. We don't have to waste our time and energy going through different financials of different stocks thinking which ones are we going to pick. Just invest in a simple, low-cost index funds, hold it for life, and we should do pretty good in 20-30 years' time. Fortunately too, in the UK, we've got stocks and shares ISAs which we can use, which means that every single tax year we've got up to £20,000 worth of investment we can put into an account, which gives us completely tax-free earnings. So if you choose to invest in an index fund or different index funds inside your stocks and shares ISA, that's probably one of the most cost-effective and cheapest ways to invest in the stock market overall. It's the lowest cost, most tax-efficient vehicle you could imagine. And all that means really is more money in your back pocket and less money in the fat cats. In the US, the equivalent is the Roth IRAs, but I don't think they're quite as exciting, and certainly they don't give as much as £20,000 a year tax-free. So sorry guys, you're going to have to move to the UK if you want to have a bit of stocks and shares ISA action. Without a doubt, the undisputed champion, one of the best performing indexes of all time, the S&P 500. This is effectively just a basket of the top 500 companies in the US by market cap, and this gives you a huge diverse range of companies all the way from technology, manufacturing, pharmaceuticals, retail, etc. And its growth has been astounding. Just over the last 5 years, you've returned over 102% back to shareholders. Now, there's a ton of funds which try to mimic the S&P 500, all called different kinds of names. But for this one, for the Vanguard one of the most popular we're looking out for today is the S&P 500 UCITS ETF, and the ticker symbol you're looking for here is VUSA. Remember, like I said before, because this is an exchange traded fund, it's bought and sold on the stock market, which means you can actually get hold of it through multiple different routes. So you can go to Vanguard directly themselves, but also if you use any other platforms like Free Trade or Trading 212, just search for VUSA and you'll be able to find it and invest in it there. Also, a little trick here, if you want to buy into the exact same fund, the S&P 500 tracker, but you want to spend your hard-earned US dollars, then the ticker symbol you're looking for is VUSD. Let's have a quick high-level glance through this fund on the computer and just see what we find out. Okay, so let's have a quick look through the datasheet for VUSA, the S&P 500 UCITS ETF that we just spoke about. If we go to the Vanguard website, we get a good high-level overview of what's going on with this fund. We can see current price of just over £60. It tracks 507 different stocks, which you can go into here. Probably one of the most important things with all these funds is looking at the ongoing charges. So this has an ongoing charge of 0.07%, which is extremely cheap. If you look at any active managed funds, you're going to be looking at fees of 0.5, 0.8, even close to and above 1%. and taking into account 0.07 is incredibly cost effective. Vanguard also have a risk score as well, so have a look at this. Relatively high risk because of course they consider this to be all equity. So you can see on this fund there's a huge amount of assets controlled, over $30 billion, so your money's poured in with lots of other people's on this one. We can look at past performance, although of course that's never a guide to future success, but it's been extremely reliable. And of course, as we all know, it's had a pretty good run over the last few years. We can see just between 20 and 2021, we've got over 40% return. And what's interesting here, of course, is how close that it actually monitors the S&P 500 itself. And the only difference really should be the difference in fees and potentially some dividends. And then finally, there's a nice little graph here which says if we had $10,000 back in January 2016, we'd end up with $22,000 here in 2021. We'd be in a pretty good place. If you need any more information on this one, don't forget to consult a professional financial advisor if you need one. Otherwise, there's loads of information online. Feel free to do your own research, and this might be the only fund you need. In second place, actually, it's not a fund at all. It's the like button. One of the best funds of all. It's given 100% return year on year for the past 50 years. If you could just turn that blue for me, if you've enjoyed the video and you're finding it useful, it really helps out small channels like mine get to some more people. Without further ado though, let's get to the next one. This next one will broaden your horizon slightly just outside of the United States. And rather than own just a small part of the stock market with the S&P 500, why not own the world?
I'm the king of the world!
This one's the FTSE All-World UCITS ETF and the ticker symbol is VWRL. This index tracks over 3,600 companies across 50 different countries, and according to Vanguard, it gives you a 95% exposure to global equities markets, which pretty much means that if this company is investable, you've got some money in it. Having a fund like this which tracks the entire world means that you're not going to be affected by local national downturns. For example, if the US has a recession but the rest of the world is still going up, or emerging markets are having a great play and some of the tech companies are having a bit of a bust, you'll be covered with everything. Rather than owning the needle, as they say, you'll own the whole haystack. As we know, it's almost impossible to try and predict what's going to happen in the next 5, 10, 20 years, so rather than trying to predict which countries are going to go up, just own the whole world and you should be in a pretty good space. Now let's quickly have a look at the charts on this one and have a look at the data sheet. This is the FTSE All-World UCITS ETF, as I mentioned, ticker symbol VWRL. As you can see, over 3,600 stocks is tracked in this fund. Current market price is just over £85 a share. The ongoing cost, slightly more expensive than the other tracker, but still relatively low compared to other funds if you look out there. That's 0.22%, just bear that in mind. Again, we've got another risk score of 5 on Vanguard's scale between 0 and 7. And again, this is because we're looking at more equities and we don't have a mix of bonds here or any other ultra safe government-backed investments. Some key information here, you can see total assets under play is $8.5 billion, so certainly smaller than the tracker on the S&P 500. Past performance has been pretty steady and pretty rock solid really. Again, a good growth from last year as you would have seen from 2020 to 2021. Some fair growth in the years gone before, but overall pretty decent average to be honest if you just own the world. And what's key, I guess, really important is regardless of the stock market performance, we've had no negative years, so your money's always grown. Here again, looking at the charts, a $10,000 investment back in 2016 would get you nearly $20,000, so you've nearly doubled your money coming round to 2021, which is some pretty good results there, really considering that in the last 5 years. If you need any more information on this one, feel free to consult these documents to have a look through for more detailed holdings and where your money actually is. But ultimately, this is a pretty good shout. This could be the only stock you need to own in your portfolio potentially. On to the third one, let's bring it home. Let's show a bit of love to the FTSE 100. If you don't already know, the FTSE 100 is a list of the top 100 companies based out here in the UK, but actually they do most of their revenue globally, to be honest, and there's some huge household names here on the list. It's not been the best grower recently, but it's got some huge potential and actually pays quite nice dividends. Over the past 5 years, it's actually delivered back over 40% in returns. Now, most of that's actually come through dividends, and if you take that off, it's only really grown by 3%, but could mean it's a good one for the future, right? This one's called the FTSE 100 UCITS ETF, nice and easy to remember, and the ticker symbol is VUKE, or VUKE. This one's quite easy to remember because it sounds like puke, or it sounds like Duke, as in Duke Nukem. You're never going to be able to forget VUKE now, are you? The FTSE 100 VUKE. What a load of puke, or a Duke. Or a Duke that pukes to remind you of VUKE. Let's have a quick look at the charts and see what this one holds. So here we are doing a homecoming now with the FTSE 100 UCITS ETF, VUKE, as I mentioned before. So at the moment, here's the latest information. We've got 102 stocks tracked in this index with a market price of just over £30. A nice low fee here, not as low as the S&P 500, but 0.09%, which is great. There's a slightly higher risk score here from Vanguard, 6 out of 7, so you'll have to do your research as to why they've got that. Probably because the FTSE 100 has been a little bit more volatile recently in terms of the fact that it's not necessarily delivered a fantastic result, to be honest, compared to other indexes. Although the dividend's been pretty steady, which is one thing they're going for at the moment. Total assets under control here, £3.5 billion. And of course, it's trying to track the FTSE 100 index here in the UK. Past performance, again, is never going to be one for future results, but unfortunately, we did have a little bit of a decrease here coming back in 2019 to 2020. So we do have a significant drop there. Some good recovery, of course, in the most recent year, and some positive numbers across the years before. But as I mentioned before, the FTSE 100 has been a little bit poor recently in terms of performance. A great dividend payer. Who knows what's going to happen in the future? Could there be loads of undervalued stocks in here? And remember, the FTSE 100 generates a huge amount of its income outside of the US. So these big global companies don't just operate inside the UK, they operate internationally. But I guess where tech is dominating recently, the FTSE 100 kind of stagnates a little bit because it's mainly financial services and other kind of companies that are on that list. So no surprise there that our $10,000 investment in this one would only really net us $13,000 in terms of returns over the last 5 years. So not a particularly amazing return, this one. But who knows what can happen in the future? This could be a good one. I think it's always good to have a little bit of your home market, especially the FTSE 100. It's been a traditional good place to be. And finally, not in last place at all, just last on my list in this video, is one for the emerging markets. This one's the FTSE Emerging Markets UCITS ETF, called with a ticker symbol of VFEM. Sounds like a really rubbish radio station, but probably got some decent prospects, to be honest. As the name suggests, this one looks at emerging markets. So these are markets outside of the US and established economies in Europe, and looking for ones that are going to have much more potential and much faster growth. So potentially putting your money in these over the next 5 to 10 years could yield you some amazing results. As we've said before, we have no idea where the growth is going to come from over the next 5, 10, 20 years. Is it going to be tech stocks out of the US? Is it going to be China? Is it going to be Africa? Who knows? So having a bit of your money diversified into places like emerging markets is not a bad shout at all. Now, of course, with emerging markets and smaller companies, always comes a little bit more risk, but without risk, there's no reward. And ultimately, stocks are the same thing. More risk, more reward. But I wouldn't want to put all my eggs in one basket. Again, let's quickly jump over to the computer on this one and have a little look through with the data sheet. So looking at this final one on the FTSE Emerging Markets UCITS ETF, VFEM, we've got a nice big basket of stocks here of over 1,863 companies. An ongoing charge here, again, is relatively low, but slightly more expensive than the S&P 500 that we've seen there at 0.22%. We've got a market price of £49.55. Again, we're looking at high risk. As we spoke about before, in emerging markets, there is risk there that these smaller companies and less established companies could quite easily go out of business and get beaten by some of their competitors. However, there is an element there with high risk comes high reward, because of course some of these companies could have extremely high growth, and some of these other economies are growing a lot faster than the UK or the US, for example. If we look at what's under management, we've got just over $2.7 billion. And of course, we've had some relatively strong performance from this fund. We did, of course, very similar to the FTSE 100, there was actually a dip in the year gone by. So you will need to hold for the long term, most likely. But again, who knows what's going to happen in the next 5 to 10 years, ultimately. It's good to diversify and make sure that you've got a solid portfolio and one that you can just pretty much set and forget. And looking at our $10,000 investment on this one, we've seen we've grown to above 17,000, which is pretty strong, to be honest. And nothing to be sniffed at, but you'd have to have some strong gonads and making sure that you protect yourself when you're seeing those dips. Pretty much just forget about it though. If you're going to be holding this one for 10, 15, 20 years, it could be a solid fund for a nice diverse portfolio. Okay, that's a wrap. There's loads of funds out there that you can invest in, but this should be a good place to start. In fact, if you include other ETFs in this list, there's like 3,600 different funds, and I think that would take me quite a long time to try and go through. This should put the majority of investors in a pretty good state. That's regardless of whether you're a beginner or you're more of an experienced investor. Buying and holding index funds has proven to be an amazing strategy over the long term, and ultimately means you can spend more time doing the things you're interested in rather than going on videos on YouTube saying which stocks are going to be hot for the next 24 hours. If you found the video useful at any point, drop me a like, subscribe for more. I'll see you in the next one. Thanks again for joining me.